Very bearish day. Only 3 sectors on the S&P higher, and they're all quite defensive: real estate, utilities, consumer staples. But just going back to Rick's report and some of those intraday charts on the yields, we had such a bearish negative open to the trade, with some record all-time lows for various European nations dragging US yields down higher, that actually where we ended up could have been a lot worse. Mike, your take on exactly that, where we did end up? I mean, still down a lot, but off the lows.
Yeah, not actually down tremendously in terms of where we've traded in the range, right? We closed above Wednesday's low, or Wednesday's close, actually, in the S&P 500, and actually not much of a net loss after 10 a.m. when we did get that ISM report. So I think the big story is the market after August, which was so kind of exhausting and choppy and volatile and surrounded by so much negative anticipation of a bad economic outcome, that we've almost braced for what we're getting in terms of the data so far, and the fact that September tends to be a bad month. So is it enough just to have negative sentiment and, say that it's priced in? I doubt that it's enough, but until further notice, we're in this trading range, and we've managed to hold up here, even though Treasury yields have made marginal new lows.
And, Rebecca, the fact that we did see utilities, real estate, consumer staples, all of those more safe haven sectors finish the day positive, makes sense to you? What do you think of the valuations here?
Yeah, it's interesting, because if you look at the S&P overall, we're rich, but we're not excessively rich. But when you go under the hood and you start looking at some of those sectors, some of those defensive sectors, the valuations do feel incredibly rich to me. As I think about what we're going to see for the rest of this week, obviously we've got all the big Brexit stuff, Wilf, that you've been talking about. That's going to affect sentiment globally, including here in the U.S. And I would keep a very close eye on what sterling does, because that's going to affect the euro and, in turn, the dollar, which is going to affect U.S. multinationals.
Yeah, and the Chinese yuan's not helping the dollar either, which you've been looking at as well, Rebecca.
Absolutely. Euro and sterling, it's really important, are part of how China manages its currency basket. So when the euro and sterling go down, it actually drags down China also. And again, all of those things together are pushing up the dollar like a toothpaste tube being squeezed.
Maddi, clearly there's a lot of headwinds for markets. At the same time, this month might see a big bout of monetary stimulus again from central banks around the world. Is that enough to help stocks once again?
No, I don't think it's enough. I think there are 3 key things that are really supporting equity markets here. So number one, it is monetary policy, but also fiscal policy that we're seeing. Also lower bond yields, which can support higher multiples, so a multiplier effect there. And then the third thing is the U.S. consumer, which continues to be strong here, 70% of U.S. GDP. We continue to see the growth even with releases last week. So those are the 3 things that we see as supports for the U.S. equity markets here.
Maddi, in fact, we saw another multi-year high today for the dollar index, the strong dollar. Are we going to be hearing more about this from companies in terms of earnings when we get to those third quarter numbers in a couple of weeks?
We'll certainly see it impact earnings. I think the key thing that it's impacting right now, though, is the yield curve. So we see more buyers coming into the long end of the yield curve now, because they don't need to worry so much about hedging the currency. And so we think that's kind of the cause of the anchoring effect that we've seen in the yield curve, more so than it is concern about recessionary fears.
And now more corporate... Oh, sorry, Rebecca.
No. I was just curious on the fiscal policy. I know there's hope that Germany will do something. China's doing a little thing at the margin. Is there something I'm missing? Where are you seeing fiscal stimulus coming through in a major way?
So I think it's mostly China that we expect to see major fiscal policy coming through. Not so much in the property sector, but in other areas of their economy. And I think that's the key thing that is going to lean against the trade rhetoric. So China sees some support here from that.